Well, good afternoon, everybody, and thank you for joining us for our latest tax update for professionals. For this particular webinar, what we're going to do is focus on the recent autumn statement and hopefully keep you up to date with what's been happening over what's been a very turbulent, to say the very least, couple of months, where we've, particularly in the world of tax, where we've gone through a couple of chancellors and a couple of prime ministers. And I think, as at today's date, I think Jeremy Hunt is still the chancellor. So, all being well, we'll have a bit of stability going forward from now on. So, usual format, we'll spend the next 40 to 45 minutes going through various topics. I'll be covering off business taxes. Then my colleague Vicky Hughes will be dealing with private client matters, and then Paul Clark will look at tax dispute and resolution and what's been happening in that particular area recently. We'll take questions at the end. Please feel free to use the Q&A function on Zoom to send your questions across to us, and we'll aim to get through as many as possible. So without further ado, let's crack on. And first of all, I must apologise, my voice, it is a bit crackly today, just recovering from a cold. So bear with me, please. Okay, let's look at the headlines as far as business taxes are concerned. Well, starting off very simply, it was confirmed that the increase in corporation tax to 25% for larger companies will still come into play from the 1st of April next year. So if you might recall, this is where companies have profits more than £250,000. The 19% rate will still apply to companies whose profits are up to £50,000, and then we have the marginal rate in between those two limits. So we'll all be dusting down those old calculators we used a number of years ago when we had various rates of corporation tax in place to work out exactly what rate of tax we'll be paying on the profits we'll be making. Now, the limits of 50 and 250,000, they are for single companies. Where you have groups or associated companies, those limits are reduced on a pro rata basis. So, for example, two associated companies, you'd have profits of 125,000 and 25,000 as being the limits. They're also reduced for short accounting periods as well. So there's no getting around the provisions by reducing the accounting period for the company. What this means practically is that we probably need to look at the corporate structures that we have in place, decide whether we still need all those companies we've got dotted around, if that's the case, that are owned by the same shareholders, not necessarily in a corporate group, of course, could just be common shareholders. It's common control that we're looking at here. So if there are companies that are practically dormant, let's make them properly dormant. If any trades can be consolidated into a single company, perhaps look at doing that, just to reduce the number of companies that we've got around, so we have as much of those bands to play with when it comes to the corporation tax rates. What we'll also have when we're looking at excuse me, associated companies, we're looking at things such as the concept of substantial commercial interdependence. So we may have two or more companies which have common shareholders and common control, but there might still be a get out if we can show that those two companies are very independent in terms of how they work. So there's plenty more to think about going forward from next April in terms of the ownership of companies, and there's a bit of time now to plan ahead before those new rules come in. It's from the 1st of April next year, like I say there. The next change I wanted to highlight, and this is quite significant, is around research and development tax relief. Now, for SME businesses, it's been severely curtailed in the recent statement. I think we're probably all aware there has been concern at HMRC around fraud and abuse of R&D tax reliefs. There have stories of very spurious claims going into the revenue, and of course, from HMRC's perspective, they've dealt with R&D with quite a light touch, to be fair, over the years, and so the majority of claims probably didn't get the scrutiny that they should have, and therefore, the tax relief has been given and repayable tax credits made, probably based on flaky foundations for some claims. So, what's changing from next April? Well, as far as the SME relief is concerned, the enhancement is reducing from 130% to 86%. So this is the figure by which the R&D expenditure gets multiplied by to get the additional tax relief. So for £10,000 of qualifying R&D expenditure, the current rules are that you get an additional £13,000 of tax deduction. Going forward, it will only be 8,600 additional tax deduction. Now, if you have a large company who'll be paying corporation tax at the 25% rate from next April, that reduction is mitigated to some extent in that it's worth, effectively the relief is worth 21.5% compared with 24.7% at the moment. But of course, if you've got a small company who still pays tax at the 19% rate of corporation tax, the impact of this will be far greater. There is a more significant reduction in the repayable tax credit for SMEs. So this is reducing from 14.5% to 10%. So the repayable credit comes into play where you have a loss-making company that's undertaking R&D. And so what that company can do is surrender those losses for a repayment from HMRC rather than carrying those losses forward. But the rate of repayment is being substantially reduced, as you can see there. So the benefit of that repayable credit is reducing from 33.35% to 18.6%. So that's quite a significant decrease and will impact a lot of businesses, particularly a lot of startup businesses rely on the repayable R&D credit to help fund that business going forward. So this could have quite a significant impact on genuine R&D companies. Now, on the flip side, the research and development expenditure credit, so this is the R&D regime for the larger companies, that's increasing from 13% to 20%. And so the benefit in tax terms increases from 10.53 to 15%. I think what this signifies, and certainly it was mentioned in the documents as well that accompanied the statement, was that the Treasury and HMRC, I think, are looking at aligning the two reliefs. Now, it does make sense from a simplicity perspective in terms of having just a single tax relief for R&D, and I suspect it probably looks like it's going to be more along the lines of the RDEC rather than the SME relief. Both of those reliefs are worked out in slightly different ways in terms of how the tax benefit flows through. We'd already had an announcement that from next April, there are going to be changes around the R&D claim process. It's going to be more of an online process going forward. There is going to be a requirement to notify HMRC in advance that a company will be doing R&D. At the moment, understand that if companies have currently made R&D claims, they won't have to go through that process. It will just be new R&D businesses that will have to make that claim. But nevertheless, there is going to be more of a compliance burden going forward in terms of claiming the relief. And this is all part and parcel of HMRC's drive to try and stamp out the more spurious claims and the avoidance that's taking place around R&D tax relief. Again, as you may well be aware, from next April, the sorts of costs which can qualify for R&D relief are going to be expanded as well to incorporate data licensing and cloud computing and such like. There will also be restrictions on expenditure on overseas subcontractors, subject us to some exemptions in particular circumstances. So all change as far as R&D is concerned. So moving on to other business matters. Well, it was relief, no change to business asset disposal relief. A lot of speculation beforehand that CGT was going to be changed for businesses, but nothing was announced on that front at all. So we're still as we were as far as BAD-R is concerned. Also welcomed was the announcement that the annual investment allowance of £1 million is going to be made permanent. So we've had this situation over the last 10 years or so, where the AIA limit has gone up and down, and we had all those transitional rules we had to work our way through when an accounting period spanned a change in the rate of the annual investment allowance, and it all got very confusing. But hopefully we've got some consistency now as far as AIA is concerned, and it's £1 million per year going forward now. But do remember that as far as the super deduction is concerned, so this is the 130% first year allowance for qualifying expenditure, that ends on the 31st of March next year, expenditure up to that date. So when you're looking at CapEx plans, please bear in mind that the super deduction will be finishing at the end of March. Now, something that there was a bit of flip-flopping on over the last couple of months is off-payroll working. So the changes announced by Kwasi Kwarteng, remember him, they have been repealed. So the what you might call the old or the new off-payroll working rules are still in place. So where you have either a public sector or a medium or large private sector engager, they still have to go through the process of determining the status of any contractors they take on board. And then you have this flow of the status determination statement making its way up the chain, and the contractor is paid according to what that status is. So if it's inside IR35, then any payments to the contractor are subject to PAYE and NICs. If it's outside IR35, then you can still pay gross. What else have we got there? Well, first year allowances for electric vehicle charging points, they have been extended to the 31st of March 2025, or the 5th of April 25 for unincorporated businesses. So these are capital allowances, first year capital allowances at 100% for EV charging points. The VAT threshold registration and deregistration, they've been frozen. So for registration, it's up to the 31st of March 24 at £85,000. Deregistration threshold £83,000 until 31st of March 26. Now, of course, with the impact of inflation at the moment, that's undoubtedly going to mean that more businesses are brought into compulsory VAT registration, because prices are increasing and therefore turnover will naturally increase as well. And just a couple of points around the annual tax on envelope dwellings. So this is where you have residential properties which are held in a company, excuse me, over £500,000. The charges are increasing by inflation, so that's 10.1%. And so the starting charge from next April will be 4,200. It's also worth remembering that the valuation date for ATED properties, which refreshes every 5 years, there'll be a new valuation from the 1st of April next year. So any properties that are valued at more than £500,000 at 1st of April 2023 will come into the ATED regime. Worth remembering there that where you have properties that might be rented out as part of a property business, there might not be an actual ATED charge because there are various reliefs available. However, you do still need to go through the process of making a claim for that relief. So there is still a compliance angle to it for those more valuable properties. Now, shortly, Vicky is going to take you through the tax rate changes in more detail in terms of personal tax. But what I thought it'd be worth just looking at is how those changes affect the effective tax rates when we're extracting profits from businesses. So what we're looking at here is an unincorporated business taking profit purely as a salary from a company. And the third column is taking a small salary around about the personal allowance level and the rest in dividends. And as you can see there, there is still, when you're looking at it from a company perspective, the dividend route is still slightly more beneficial than a salary route, particularly at smaller levels of profit, because the differential between dividend rates and income tax rates on earnings. But as soon as those profits start to increase, that differential starts to narrow. And that's a function of not only the increase in dividend rates, but also, of course, the increase in corporation tax rate from next April, which obviously impacts the effective tax rate for dividends. What's also apparent from looking at those numbers there is the question around incorporation. You know, should we incorporate a business or not? And certainly a lot more thought needs to go into that process now. It's more nuanced because one aspect of incorporation is whether you're actually going to draw out all of those profits or whether you need to draw out all of those profits. But certainly looking at it coldly, where you start to make profits more than, say, £150,000, if all of those profits would need to be drawn out from the company, then a company may not give you a better overall tax position. But clearly lots of other factors to be taken into account there. What this other table then goes on to look at is we've got a scenario where somebody is already taking a dividend or a salary from a business, and then we're saying, okay, we want to top that up with either a bonus or an extra dividend. What's the best way of doing that? And now, because we've got the change of corporation tax rate from next April, we need to think about, are we a small company, are we a marginal company, or are we a large company? As the rate of corporation tax for dividends will have an impact there. So again, what we tried to show on the tables there is the impact for a high rate taxpayer and an additional rate taxpayer of drawing a bonus or a dividend from the company. And again, you can see the the variations there, that once you get into a large company scenario, a bonus actually becomes slightly more efficient than a dividend. And that's purely the interaction between corporation tax and income tax rates. But all the way through, there's not a huge disparity between the two routes. Certainly nowhere near the difference as there was a few years ago. Now, finally, something a little bit kind of off on a tangent, not autumn statement related at all, but it's something that I've seen mentioned a few times now in the in professional publications around a potential trap where you've got a non-resident company with a UK property. Now, it's sort of scenario that won't crop up all of the time, but if it does, then it can actually lead to some quite interesting, I'll use that term reservedly, tax analysis. So the example is we have a non-resident company that's got a UK property. It's not rented out. So it could be a company that's actually falls within the ATED provisions. So the company sells property at a gain, and you'd normally think, well, any corporation tax payable there is due 9 months from the end of the accounting period. That would be the usual date of payment. And if the profits are more than 1.5 million, well, you've got the transitional year for quarterly instalment payments. But no, that's not the case, in fact, because if this company has no other activity, the sale of the property will mean there's just a 1-day corporation tax accounting period. And quarterly instalment payments for very large companies, so this is where the profits chargeable to tax are more than £20 million. For a 1-day period, that limit gets prorated down to 54,795. Now, for very large companies, you don't have the transition period like you do for large companies moving into QIPs. So when a small company becomes a large company, in that first period, you're not in the quarterly installment regime. It's the second period that you breach the rules that you brought into the regime. But for very large companies, there's no transition. Now, HMRC have partially, at least, recognised this issue because you're not necessarily going to be aware of this. And by concession, what they say is that tax is due 3 months and 14 days after the end of the corporation tax accounting period. Now, of course, this is just a 1-day period, so there's still not a huge amount of time before you pay the tax. It's 3 months or so afterwards. But this only applies if the only reason for being chargeable to corporation tax is the gain itself. So if in that company the property is also rented out, and so you have some rental income as well, then the corporation tax is actually due on the date of disposal. So it's just something to flag up there as something that you might come across your desk at some point. It's something that's very easily overlooked because why would you go into that kind of level of detail? But it's certainly something that's worth being aware of. So now I'll pass you over to Vicky, who will go through some of the private client tax matters. Thank you.
Good afternoon, everybody. I'm going to go through the personal tax detail from the recent autumn statement, and this will tie into some of the slides that Craig's covered off just at the end there. So in terms of thresholds, one of the key changes is that the threshold for the additional rate of tax has been reduced. So it's been reduced from 150,000 to 125,140. So they've got to that figure because they've aligned it to the point at which taxpayers lose their entire tax-free personal allowance. So what this means is that those earning £125,140 or more will pay tax at the marginal rate of 60% over £100,000, and then at the 45% rate when the personal allowance has been fully tapered away. So if we look at somebody earning more than 150,000, which is the rate at which previously they would have moved up to 45%, they'll end up paying an extra £1,243 per annum. Now, a key theme of the budget in terms of the personal tax announcements was that they're freezing lots of the levels or reducing them. So the personal allowance basic rates and higher rate thresholds have been frozen until April 2028. So that's actually 2 years longer than was announced in the past. And so unfortunately, if we assume that income levels rise with inflation, that means that individuals are being pushed into higher rate tax brackets much more quickly than in the past. So the taxes that people are paying are going up. Then moving on to look at some of the other aspects. One of the key changes has been to the taxation of dividends. Now the rates of tax are unchanged from the current tax year that we're in, and there's going to be a reduction in the amount of the dividend allowance, so the amount that gets taxed at the 0% rate. The dividend allowance is being halved in April, so that's going down to £1,000, and then it's halved again the following April, so it'll only be £500 per taxpayer. And unfortunately, as you'll be aware, unlike the NIC rates, the 1.25% additional tax rate hasn't been reversed. And so the rates of tax payable on dividends remain at 8.75%, 33.75%, and 39.35%. So looking at the impact that this will have on taxpayers, additional taxes up to £338 will be payable by a higher rate taxpayer next tax year, and £506 the following year. A basic rate taxpayer will be up to £87.50 more next year and £131 the following year. And as well as this, because the allowances have gone down, potentially more taxpayers with small amounts of tax will be dragged into the self-assessment tax return system. So there'll be more compliance for you to help your clients with. Then these might not apply to everybody, but some other announcements were that the Seed Enterprise Investment Scheme, the lifetime amount that an individual can invest in that has actually doubled up to £200,000. And there has been an increase in the range of companies that can qualify, which is good news. Then some tax exemptions have been confirmed for certain compensation payments. In the press recently, there's been discussion of those that are receiving payments under the Infected Blood Interim Compensation Payment Scheme, and also the Post Office Compensation Scheme for the overturning of historic convictions. And this clarifies that any payments under that are both exempted from tax, which is a welcome clarification from those that are receiving those amounts. Now turning to capital gains tax. The annual exemption is being reduced, and again, this is happening over a couple of tax years. So the annual exemption is reducing to £6,000 from the 6th of April 2023, and for trusts, that means that it's halved to £3,000. And even then, if the settlor of those trusts is set up more than one trust, that £3,000 limit will be reduced even further down. So they could have very restricted allowances if it's a trust we're looking at. And then the following tax year, so 6th of April 2024, the annual exemption from an individual will reduce down to £3,000. And that means that the maximum a trust would get would be £1,500, but it could be even lower than that for the same reasons that we've just discussed. So this means that it will be likely that taxpayers might well end up paying more capital gains tax than we've been used to. Often clients try to limit their capital gains to within the annual exemption, but obviously there's quite a dramatic reduction in that amount. So it may be likely that we'll have a lot more tax returns, especially for trusts, and it might be that there's small amounts of tax being collected, but the compliance burden is increasing. What the announcements did do was that confirm that the amount of proceeds that you take into account when you need to complete the capital gains tax pages of a tax return has increased to a flat 50,000. It was slightly lower than that in the past and in this current year. But if you have a client that has proceeds of £50,000 or more, strictly they should be completing the capital gains tax pages of their return as well. Now, there have been no changes to the rates of tax that apply for capital gains tax purposes. So for basic rate taxpayers, you've got the 10% rate or 18% if it's applying to residential property and carried interest. And then the main rate, so for higher and additional rate taxpayers, they remain at the 20% for most things, or 28% for residential property and carried interest. Also, there were references to something that I discussed in detail in the last session. It's to do with the treatment of transfers between the parties when they're getting divorced. And this is to do with nil gain, nil loss transfers. From the 6th of April next year, the treatment on separation will apply to the transfers of assets for a longer period. And so that will be for transfers of assets between spouses for 3 years after separation. So it's very much extending the period, and it should make it simpler for separating parties to deal with their assets. Where assets are transferred as part of a formal divorce agreement, then the period for the nil gain, nil loss treatment will be even longer than that. In some of the initial discussions straight after the autumn statement, there was some discussion as to whether this treatment applies for 3 tax years or just 3 years after separation. And I think it's now been clarified in the paperwork for the finance bill that it's a 3 tax years after separation. But that's something that will be confirmed after the 6th of April 2023 when the finance bill has become the Finance Act. There has also been an anti-avoidance announcement. I'm not sure that this will have a significant effect on many of our clients or your clients, but this does close some tax planning for non-DOMs, and it took effect from the date that the announcement was made, so from the 16th of November. Where there are shares in a UK closed company are exchanged on a tax-free share-for-share exchange in a non-UK company, and the individual has more than a 5% interest, this is where these rules would apply. And the shareholder has to pay tax on the dividends from the non-UK company and capital gains tax on the disposal. So it's extending the tax net and preventing them from being able to be outside the scope of UK taxation. Then another tax to consider is inheritance tax. And unfortunately, the nil rate bands have been confirmed that they're staying at their current levels for a further 2 tax years as well. So for the purposes of this, they're remaining fixed until the 5th of April 2028, and it will be over a decade, far longer than that, that the IHT nil rate band has been at that £325,000 level, and the residence nil rate band at the £175,000 level. So as I've put there, the nil rate band was £325,000 in the 2009-10 tax year. So really, there hasn't been any movement, and more estates will find themselves paying inheritance tax as the value of assets goes up with inflation. Also, the level at which the residence nil rate band is tapered down continues to be at that £2 million threshold. So it is something to consider for your clients if they're looking at inheritance tax planning, is to try and seek to ensure that where you've got a married couple, their combined estates for inheritance tax purposes are below the 2 million mark between them. So in terms of thoughts then, things that clients could look to do before the 6th of April is use their allowances for the current tax year, because lots of these are becoming much more restricted after that. Consider interspousal transfers if the assets are not held equally, or there's a big disparity in their income levels, looking at interspouse transfers to maximise the use of allowances where some are currently unused. They could look at tax efficient investments, things that won't give rise to taxable income going forwards. And they could always look at their pension scheme contributions and see whether pension funds might be an appropriate place to make investments that again would fall outside their tax calculations. When it comes to looking at investments, obviously they need to take appropriate investment advice, but just looking at the pure tax consequences, these could all be things that might help people manage their tax liabilities going forwards and prevent the stagnations of the tax thresholds and the reductions in the tax-free amounts having such a negative effect on them. So I hope that's been helpful as a confirmation as to what the key personal tax changes have been, and I'll pass over to Craig now to talk about his points for tax investigations and inquiries.
Good afternoon, everybody. In the field of tax investigations and inquiries, to begin with, let's take a look at an announcement that was made, as these things always are, right towards the end of the autumn statement. It was stated that there is to be yet further investment in tax compliance activities, as HMRC increasingly call it now, with a further £79 million in funding two target areas. One is the wide-ranging area of tax fraud, which will always yield a healthy return in virtually every case that I can imagine if fraud has been involved. But secondly, and increasingly, we're seeing non-compliance by high net worth individuals. We saw in the previous presentation that I did a couple of months ago, where HMRC have recently sent out to 1,000 high net worth individuals the invitation, as they put it, to take part in a chat before those individuals submitted their 21-22 tax returns, which a number still have to do because the deadline isn't until the end of next month, the end of January. The profession and the advisors were bypassed in that exercise, and HMRC was seeking to engage directly with the client or the taxpayer if they are unrepresented, and most will be represented as high net worth individuals, if not all. And they've plainly got the flavour and the taste for this activity because they see that there are a number of areas within a high net worth individual's returns that, whilst there may have been notification within the return itself, maybe there hasn't been sufficient white space disclosure if a matter was open to interpretation. And HMRC do see this as an increasingly fertile area for them to concentrate their activities. Now, it doesn't take Einstein within us to work out that if they're spending £79 million in this area, and they reckon they are going to receive £725 million in additional tax as a result of this activity in the next 5 years. This is almost a tenfold return on the investment. And this is why increasing funds are being placed into this area. As regards the distinction and the crackdown on avoidance and evasion. Avoidance, as I think we all are very clear, is it's activity that is strictly within the tax legislation, so it is within the law. But if it's aggressive avoidance, as HMRC increasingly call a number of the schemes that are out there, then it was taking the legislation in a way that Parliament, as they say, never intended. And HMRC have been very successful in the last few years of not only highlighting the promoters of these schemes and taking steps basically to close them down, but also to get the tax in far sooner than they would otherwise have to do if they took the cases through the courts. For example, the accelerated payment notice legislation and the follower notice legislation. So they have had a very high return on a number of initiatives in tackling avoidance. And as regards evasion, as we all know, is outside the law. It's tax fraud, basically. And HMRC have identified that in the bigger picture of this overall activity, they anticipate that they will raise an additional 2.8 billion by the end of the next 5 years. So the question is, where is this likely to come from? One of the campaigns and issues that HMRC have had recently is an increasing attention to issuing what they call nudge letters. These are prompt letters, if you like, to a particular type of taxpayer or a sector of the economy, where information that HMRC think they hold is sufficiently reliable for them to query by issuing out pretty standard letters. And we've seen a few of these in one or two examples where, for example, they have decided that landlords remain an area where there may be an underdeclaration of profits for tax purposes and thereby underpayments of tax. And what HMRC have done with regard to a landlord campaign is to identify via the tenancy deposit scheme. And this is where a new tenant goes into a property that they are renting from a landlord, and the deposit scheme requires the tenant to typically place 4 to 5 weeks equivalent rent in a particular fund, which is a deposit scheme administered separately. HMRC now have access to that information, and they can do a simple calculation whereby they can see if a particular figure in a deposit scheme equates to 4 to 5 weeks rent. And on a simple multiple basis, they would be able to see what the gross rent over 12 months for that property will be, or should be. And that is why they see now the opportunity to send out nudge letters in that particular sector, and they anticipate quite a significant return in tax terms as a consequence of this. A further campaign that they have identified, which was commenced recently, is with regard to information that is publicly available, for example, at Companies House. If you do a search on a particular company, you will see typically the directors, you will see the accounts, but you will also now see what they call persons of significant control being shown. And HMRC will take that information, process it through their Connect system to see whether those individuals shown as having control of a particular company at Companies House have in fact made a return of this on their tax return if they are in receipt of income or dividends from that company. Now, that isn't watertight in its analogy, simply because, for example, if you think a number of companies are controlled at least in part by trusts, and if those are discretionary trusts, then the trustees may have no beneficial interest in that shareholding. They're acting as trustees only, but they will be shown on Companies House as within this persons of significant control. So it's something to bear in mind when you act for clients where the ownership may be other than a simple beneficial holding on the Companies House record. These one-to-many letters, as HMRC call them, are going to be something that we see increasingly in a number of areas, and you should make clients aware that they may well receive these, even if there is nothing actually to be further returned. They may still receive this type of letter. It's a little prompt, little inquiry, if you like, but not a formal inquiry. That's the distinction. HMRC's compliance check activity is increasing. We see year on year further activity into this. A well-established practice by HMRC is to look as to whether employers fully comply with the pay-as-you-earn regulations, given the diverse nature, particularly as regards the provision of benefits in kind to employees. It's almost invariable that if an inquiry by HMRC is made to a company as regards compliance with the pay-as-you-earn regulations, that there will be some tax return as a consequence. And we are increasingly seeing now where a client was contacted directly by HMRC employer compliance officers, pay-as-you-earn audit people in old speak. HMRC rang the client, asked them some information about what benefits in kind were being provided, how did they apply all their payroll procedures, and generally gathering information. And the bookkeeper who took the call thought she was doing her best to answer these questions without understanding the consequence of them. And it was only when a subsequent letter was then issued by HMRC attaching a schedule of the telephone conversation with the number of points that HMRC wanted to follow up, the client realised that they've got themselves out of their depth, and they turned to us. And the point that I want to make you aware of here is that whilst these matters can be dealt with relatively straightforwardly, nonetheless make clients aware that if they are contacted by some employer compliance unit, before they answer any questions at all, however informal that call may look, that you are contacted first so that you can advise them accordingly, and you confront the call basically as and when it arises. Two other areas that we are seeing compliance activity in now, one of which is the research and development area. Craig outlined in a little bit of detail what the existing position with R&D claims is and what the vision to the reliefs will be going forward. What has really got under HMRC's skin with research and development tax relief is that there are a number of organisations out there that have seen fit to abuse the research and development tax relief. It's a very valuable relief in the right circumstances. And we've seen a number of cases and claims where we are entirely happy with the basis. But that isn't always the case, it appears. There are a number of organisations out there that either submit fraudulent claims or excessive claims. So much so that HMRC have now set up their research and development anti-abuse unit. And I think the name says it all really. And they say that they are going to couple this activity with their fraud and investigation service unit. Fraud and investigation service handles, as its name says, tax evasion fraud cases. Similarly, we are seeing activity where clients, because of the COVID difficulties and the opportunity to supplement, in many cases, business levels that are drastically reduced as a result of the lockdown, the SEAS grant opportunity, and also the furlough claim opportunity for employers under the coronavirus job retention scheme. There's nothing wrong with those claims in principle, except that in many instances they were made incorrectly, if they weren't made erroneously and deliberately so. We are seeing activity by HMRC in this, and the point to also make here is that if there is, in the cold light of day, an overclaim that was perhaps made innocently or worse, deliberately, the consequential penalty position will be significant. Because unlike, for example, in a tax computation where an error has been made, and if there is an irregularity in the ordinary course now, when it comes to negotiating and determining the penalty, if indeed there should be one, there are various categories that are gone through in terms of taxpayer behaviour. And where there is an error in a return situation, you will go through categories from innocent error at one end of the spectrum through careless behaviour, and then into deliberate behaviour, and worst case, deliberate and concealed at the other end of the spectrum. For this type of activity, where we're talking about if there's a failure to notify of an overclaim of an R&D claim or a SEAS grant that should have been repaid or shouldn't have been claimed in the first place, HMRC's position would say that is a failure to notify. And the penalty calculations are narrowed down simply between behaviour of, was it non-deliberate or was it deliberate? And they are increasingly seeking to argue that if it was deliberate and concealed, thereby giving rise to very significant penalty percentages. So it's something to be mindful of when you discuss with clients who have been impacted by the COVID position and the claims that they have made, and also those clients where you may not have done the R&D claim, for example, but one was done on their behalf by a third party. Just a reminder that there are a number of disclosure facilities out there still, and this is to encourage individuals, particularly, but companies, normally individuals, to come forward rather than wait for a nudge letter or a compliance check letter from HMRC, is to actually make the first move themselves by coming forward and making some form of a disclosure so that it covers off in the cold light of day what should have been disclosed in the previous tax year. Just a quick reminder of the current campaigns and facilities that are still out there, because the Worldwide Disclosure Facility is one that's been open for some considerable time, and the reason HMRC keep it open is because they keep getting disclosures being put to them. So it's easy business, so to speak, for them. And so long as there is any element of an offshore angle, even if there are other UK-related tax issues as well, the Worldwide Disclosure Facility can still be used. And in the right circumstances, it is well worth pursuing that line. For example, I mentioned last time as to the Euro-Pacific Bank position at Puerto Rico, where the UK tax authorities have now a list of 600 individuals who have or have had accounts with Euro-Pacific Bank, and they're checking to see whether those individuals have made the appropriate returns. Now, if they haven't, this is an opportunity before they receive the letter from HMRC to make such a disclosure. The contractual disclosure facility is still open and will always remain open so long as there is tax evasion where people want to put right, basically, because Code of Practice 9 deals with tax fraud cases. We have a couple of these cases on at the moment. There is a process to go through. It is quite a formal process. It's a lengthy process. But what it does do in those circumstances, so long as a full disclosure is made to HMRC on a timely basis with cooperation, there will be a guarantee of immunity from prosecution. And in the right circumstances, that is a very important guarantee to have. Two smaller campaigns that are still open. The Let Property campaign, we've now got the landlords angle to this that I mentioned a few minutes ago, but there is still a Let Property campaign open whereby HMRC are reminding people out there that if they haven't returned all the property rental income or they haven't returned any of it, that can be done through the Let Property campaign, which is making the first step, and thereby it will have a lesser penalty impact. The credit card sales campaign is one that we don't see very often, but it is still open. And basically what that is getting at is where increasingly now businesses are doing online sales, either wholly or a significant proportion of their income, increasingly so, is coming from online sales. And that will be by way of credit card income to begin with. What HMRC are saying is, businesses, are you sure that you have put all those credit card sales into your tax returns as part of your turnover? And if they haven't, then there is this opportunity to make a disclosure. The consequence of this being is to regularize the tax affairs, and also it will receive a lesser penalty as a consequence because the client is coming forward rather than having to respond on a prompted basis. That's pretty much the update summary that I wanted to give you.
Thank you, Paul, and thank you, Vicky, for your excellent presentations as always. I hope everybody found that that useful, and there was something there for everyone. Just having a look at the questions coming in. Nothing coming in as yet. There is one point I just wanted to raise, and that was just around. I touched on quarterly instalment payments earlier. And something that was announced when the increase in corporation tax rate was announced sort of earlier this year was that when you're looking at companies which fall within quarterly instalment payments, presently all you're concerned about is a corporate group we divide in the 1.5 million figure or the 20 million figure for very large companies. So if you've got a corporate group, you divide those limits by the number of companies in the group. Now, I still think, and I've seen nothing to the contrary as yet, from next April, the number of companies you bring into account when you're looking at those limits is on an associated company basis rather than on a corporate group basis. So it looks like that obviously that net would be widened in terms of the companies which would fall within the quarterly instalment regime. And like I say, I've seen nothing to contradict that one way or another. So a bit of a watch this space on that one. Well, as always, if you do have any questions subsequent to the webinar, please do get in touch. If there are any topics you'd like us to cover on future webinars, likewise, let us know. We're happy to cover anything that you that you feel would be of interest to you. So remains for me to say thanks again to Vicky and Paul. It's been a pleasure presenting to you all again, and everybody have a great Christmas, and we will see you in the new year. Thank you.